So welcome to today's lesson. Today we are going to focus on accounting for assets part 2. So in part 1 we looked at the fixed assets. Now in part 2 we are going to look at two types of assets, and those are prepayments and accounts receivable. So let us start with prepayments. So what are prepayments? Prepayments are expenses paid in advance. We have two examples here. Prepaid rent, for example, paying office or shop rent several months in advance. For example, now we are still in the month of September. So you pay the rent for October, November, and even December before those months come. That is a prepaid rent. Prepaid insurance, paying insurance for the next year in the current year. So you are paying before the year comes. So those are just two examples of prepaid expenses. So we are going to be looking at how we are supposed to account for prepaid expenses. Before that, we have two accounting principles which normally apply when it comes to prepayments. The first one is called accrual principle. So according to the accrual principle, we normally say that expenses and incomes must be recognized in the period to which they relate, not when cash is paid or received. So let us go back to our example. Let's take prepaid insurance. So right now we are in 2025. You pay insurance for the year 2026. So we say that the expense belongs to the year 2026 and not 2025. So therefore, according to the accrual principle, we are saying expenses and incomes must be recognized in the period to which they relate. So if the expense belongs to the year 2026, you cannot record it in the year 2025. So you are supposed to make sure you follow the financial year. So we have another principle which is followed in prepayments. That is the matching principle. So we say that expenses should be matched with the revenues they help to generate. So these two are somehow related, the accrual principle and the matching principle. If you are taking income for the year 2025, you should only deduct expenses for the year 2025. If the income is for the year 2025, you cannot deduct expenses for the year 2024 or for the year 2026. Both the income and the expense must belong to the same financial year. That is called the matching principle. So therefore, in the income statement, if you have recorded income for the current year, you should only deduct expenses for the current year. If you happen to have paid expenses for the next year, those ones should not be included because they don't belong to the current year. So let us now look at the accounting treatment for prepayments, and we are going to look at them first in the income statement and then in the statement of financial position. So in the income statement, prepaid expenses do not belong to the current financial year. So if they have been included in the expenses, they should be eliminated. So usually in an exam case, if you are given any prepaid expense, we normally deduct them from the expenses that have been paid. You are given insurance expense, and then you are told in that expense, payment for next year, insurance for next year has been included. So what you are supposed to do is to deduct that expense for the next year. So that is in the income statement, we normally deduct prepayments from the expenses. And then when you go to the statement of financial position, Prepaid expenses are treated as current assets, and that is because the business is entitled to receive the services that have already been paid. So remember, you have paid for a service that you have not received, or you have paid for an item that you have not received. Therefore, when you go to the next year, you are going to receive that service or that item without having to pay again. So next let us look at accounts receivable, also known as debtors. So debtors results from credit transactions. So credit transactions, these are transactions that don't involve cash. So the business has supplied goods or provided a service, but payment has not been received. We have two examples here. Accounts receivables come from, so the main source is credit sales, where you give goods to customers and then they promise to pay later. So those customers, we call them debtors or accounts receivable. Apart from sales, a business can also be having accrued income. For example, if the business has houses which they have invested and they receive rent from those houses, if they have not received rent for the previous month or the previous year, we call that rent accrued income. It is income they were supposed to have received, but they have not yet received it. Or it can be dividend. The year has ended. The business is supposed to receive dividend from its investment, but the dividend has not yet been received. So that also will be called accrued income. So all of them, whether they come from sales or from rent or dividend, as long as it is income that has been delayed, the business is entitled to receive it, but the income has been delayed, we call it accounts receivable, because the business expects to receive it in future. So this is accounting treatment for receivables. So we are going to be looking at it both in the income statement and the statement of financial position. So in the income statement, income must be recorded when gained, not when cash is received. You are supposed to receive that rent in this year, but you end up receiving cash in the next year. When you are preparing the income statement, it does not matter whether you have received the cash or not. You are going to include that income as if you have received it. So if the income has not been included in the profit and loss account, it must be included. And then when you go to the statement of financial position, all accounts receivables are current assets. It is as simple as that. So when it comes to accounts receivables, we have something called bad debts and another one called doubtful debts. So let us start by defining what is bad debts. So bad debts, these are accounts receivable where the customer has failed to pay or is unable to pay. So the customer promised to pay after 1 month. Then after 1 month, you have not received the money. Another month passes, another one passes. As time passes, you realize the customer is not paying. You try to follow up for the customer to pay. Still, the customer fails to pay for one reason or the other. So you make a decision that the customer is not going to pay, because maybe if it was supposed to be paid within 1 month, and now one year has elapsed, so you conclude that this debt will never be paid. It becomes bad debt. So some of the causes for bad debts include bankruptcy or insolvency. This is where a customer cannot pay due to financial collapse. Or it can be death of a debtor, where the debtor does not have sufficient estate to settle debts. The debtor dies and did not leave enough cash, enough assets to settle the debt. It can be due to dishonesty or fraud, where the customer deliberately avoids payment. It can be due to disappearance or absconding, where the customer cannot be traced. The customer has disappeared. Those are some of the reasons why businesses end up with bad debts, but we can have more reasons. Next, we have doubtful debts. So this is a provision made by a business to cater for debts that might not be paid. So when you are making a provision for doubtful debts, we normally follow an accounting principle called prudence. So according to the prudence principle, businesses are supposed to provide for expected losses, even if those losses have not occurred. So this requires businesses to estimate potential losses and provide for them even before the actual loss occurs. So maybe the customer has not refused to pay, but time is running out. So you are seeing some signs that the customer may not pay. So it is only prudent for you to assume there is a probability that the customer will not pay. So what you do, you make an allowance or a provision. So that allowance is supposed to be an expense in the profit and loss account. If the customer does not pay, how much will you lose? So most of the time, businesses set a percentage. For example, 5% or 10%. And then they say, out of the sales we have made this year or this month, let us assume that 10% will not be paid by the customers. So that one is purely an estimate. It is purely an estimate. That is why we call it an allowance or a provision. You are not very sure, but based on your experience, based on your judgment, you have seen it in the previous years that not all customers pay for the goods they buy from you. So the amount provided is based on personal judgment of the accountant or past experience with the customers. So in this page, we are only going to understand the meaning of bad debts and doubtful debts. Bad debts, these debts you are 100% sure the customer will not pay. Doubtful debts, this is an estimate. There is a probability the debt may or may not be paid. Bad debts are usually very specific. You can say specifically customer A will not pay. Why? Because customer A has been declared bankrupt. So bad debts are very specific. You can be able to identify the specific customer who you think or who you know is not going to pay. But doubtful debts, these are general. So you are saying out of all the customers who have purchased from us, let's assume 10% are not going to pay. So doubtful debts, you are not identifying a specific customer. It is based on the general customers. You take a percentage of the customers. So now we are going to see the accounting treatment for bad debts. And then we are also going to see for doubtful debts. So bad debts written off are expenses. Writing off a bad debt means cancelling the debt. It means cancelling the debt because you have realized that the customer is not going to pay. So you decide to cancel the debt and forget about it. So once bad debts are written off, these are the entries that we make. We debit bad debts expenses account. Then we credit debtors or accounts receivable. And then the balance in the bad debts account is closed off at the year end as follows. So remember here, we have debited the bad debts expenses account. At the end of the year, this amount should be transferred to the profit and loss account. And for you to do that, we are going now to credit. The first one you have debited, so the second entry is going to be a credit in the same account. So you are going to credit bad debts expenses account with the same amount, which means that bad debts expense account does not have a balance carried down. So all the amount in the account will be transferred to the profit and loss account, which will be debited in that account, meaning it will be an expense in the profit and loss account. So that is how we account for bad debts written off. Sometimes you may write a bad debt off only for the customer to resurface in the future and maybe make half of the payment or make the full payment. So we normally call those ones bad debts recovered. If the bad debt is recovered, you are just going to do the opposite of what we have done when we have written off the bad debts. Writing off bad debts, we debit bad debts, we credit debtors. So if the customer comes and acknowledges that they owe you money, or they do something such as making half of the payment or part of the payment, we are supposed to recover those debts. So bad debts recovered, you do the opposite of what we have done here. You're going to debit the debtors account or the accounts receivable, and then you credit the bad debts expenses account. In this case, because we had written it off as an expense, now it will be treated as if it is an income. So in the profit and loss account, you are going to be crediting profit and loss, not debiting. So everything that we have done here is going to be opposite if the bad debt is recovered. So next we have accounting treatment for doubtful debts. So for the doubtful debts, there are some things you are supposed to know. Let us start with the first thing. If it is the first time for a business to make provision for doubtful debts, these are the entries we make. We debit profit and loss account with the whole amount. And then we credit provision for doubtful debts account also with the whole amount. So keep in mind that this is when the business makes the provision for the first time, meaning they were not providing for bad debts in the previous years. So the difference between provision for doubtful debts and the bad debts written off accounts is that for the bad debts expenses account, this account is temporary. It is only maintained for 1 year, and then it is closed at the end of the year. But for the doubtful debts, this account is somehow permanent. The business does not close it at the end of the year. Instead, it has balance carried down, which is usually transferred to the next year, as we are going to see next. So this is a continuation of accounting treatment for doubtful debts. So if it is not the first time to make provision for doubtful debts, the entries will depend on whether there is an increase or a decrease in the provision. So if there is an increase in the provision for bad debts, let's say last year the provision was 20,000. This year the provision is 30,000. There is an increase of 10,000. So we are going to take that 10,000. We call it the increase in provision. So we are going to debit profit and loss account with the amount of increase. Then we are going to credit provision for doubtful debts account with the amount of increase. So remember, we have said if it is the first time you are making the provision, you record the whole amount. The entries are the same, but if you are making the provision for the first time, you record the whole amount. But now, if it is not the first time, you just compare the current provision and the previous provision. If it is an increase, here you are going to record the amount of increase only, not the whole amount of provision. But if there is a decrease in provision for bad debts, then you are going to do the opposite of what we have done for the increase. You are going to debit provision for doubtful debts account with the amount of decrease. Then you are going to credit profit and loss account with the amount of decrease. So it is just the opposite of the increase. And then when you go to the statement of financial position, so remember these are the entries you are going to make in the income statement or the profit and loss account. But when you go to the statement of financial position, the whole provision for doubtful debts as at the year end should be deducted from the accounts receivable. The whole provision. Remember, in the income statement you have said, apart from the first year, the subsequent years, we normally record the increase or the decrease. That is only in the income statement. When you go to the statement of financial position, it is the whole provision. The whole provision. You are going to deduct it from the amount in accounts receivable. So here we have an account, a format for the provision for doubtful debts account. So as you can see in our account, we have separated it in terms of years. We have year 1, we have year 2, and we have year 3. In year 1, we are going to assume we are making provision for doubtful debts for the first time. So remember the entries I have given you. If it is the first time, you are supposed to debit profit and loss account, and then you credit provision for doubtful debts account with the whole amount. So because this is a provision for doubtful debts account, we are making a credit entry. This is the credit side. And because the other amount will be recorded in the profit and loss account, the details here, you are supposed to show the other account where the entry will be made. So you write here profit and loss account, and this is the first time you are making the provision. At the end of year 1, you are going to balance this account by writing on the opposite side, balance carried down, and then you record the totals, you close the year. You proceed with year 2. So when you go to year 2, bring the previous balance from year 1. So this balance carried down in year 1 will be brought to year 2 as balance brought down. And then in year 2, you are going to calculate provision for doubtful debts for year 2, which you are going to record as the balance carried down. If it is 10% of accounts receivable, take that 10% of accounts receivable, record the whole amount as balance carried down. You'll just be comparing the difference between the balance carried down and the balance brought down. So the balance brought down is always the provision they had made at the year beginning. The balance carried down is the provision the business makes at the year end. The difference between the two balances can either be an increase or a decrease. If the balance at the year end is higher than the balance at the year beginning, then it is an increase. And if it is an increase, it will be on the credit side. So you are going to call it profit and loss. That is the amount of increase only. Then you record it in this account. When you go to the profit and loss, you are going to debit profit and loss account with this increase. Then at the end of the year, you just write the totals, you proceed with the next year. So one thing you're supposed to know, you don't calculate the balance carried down. You don't calculate the balance carried down in provision for doubtful debts. The balance carried down is the provision the business makes in that year. In this case, your balancing figure is supposed to be the profit and loss, which is either an increase or a decrease. So let us proceed with year 3. Year 3, start with the balance brought down, which is the balance carried down for year 2. So bring it to the beginning of year 3. Then in this year, we are going to assume that the balance brought down is higher than the balance carried down. So if the balance brought down is higher than the balance carried down, the balancing figure, which is profit and loss, will be on the debit side. And it is going to be a decrease in provision for doubtful debts. So that decrease will be taken on the credit side of the profit and loss account. And then you record the totals you close that year. So that is the format we normally use in provision for doubtful debts account. So let us do an example and hope that you will understand better using the example. So we have an example here. It says ABC Limited has a policy of providing for doubtful debts at the rate of 10% every year based on the balance of the accounts receivable. The following information has been extracted from the company's books. So we have 3 years here, 2022 and 2023 and 2024. We have accounts receivable 100,000, 200,000 and 150,000. Then you are required to prepare number 1, a provision for doubtful debts account for the 3 years. And then number 2, extracts of the profit and loss account and the statement of financial position. Before we start preparing those 3 accounts, we are supposed to start with doing some workings. And these are the workings for the 3 years. So remember, we were told that the policy of the business is to provide for doubtful debts at the rate of 10% every year. So in the first year, you just take 10%, you multiply by the accounts receivable, it will give you 10,000. In the second year, use the same rate, multiply by the accounts receivable in that year, 200,000, it will give you 20,000. Then in the last year, you do the same and you find 15,000. So we are interested in the change, whether it is an increase or a decrease. So in the first year, 2022, we don't have change because it is the first time the business is providing for doubtful debts. So we don't have increase or decrease. Then when you go to the next year, you compare the previous amount with the current amount. The previous amount was 10,000. The current amount is 20,000. So it has increased by 10,000. Then you go to the next year. The provision is 15,000. Compare it with the previous provision, which was 20,000. So the provision has decreased by 5,000. So you have 5,000 there. So when you go to the provision for doubtful debts account, we are going to use these workings to know how much we are supposed to record. So let us start with the first one. We prepare a provision for doubtful debts account. So this is the provision for doubtful debts accounts. So we begin with the first year, 2022. We have taken 10% of 100,000. So on the credit side, we record profit and loss account 10,000. So we don't have increase or decrease because this is the first year the business is making the provision. So by the end of the year, you just record the balance carried down, 10,000, and we don't show any increase or decrease. So the increase or decrease will come in the next year. So in the next year, start with the balance from the previous year, bring this 10,000 from 2022 to be your balance brought down for 2023, 10,000. Then forget about the profit and loss account here. So I said that is supposed to be the last thing you record because it is your balancing figure. On the opposite side, record the balance carried down. And the balance carried down, it is the provision the business is making in the current year, which is 10% of the accounts receivable for this year, 200,000. So 10% of 200,000 gives us 20,000. So first you record the balance brought down and the balance carried down, and then you balance the two sides. If the balancing figure is going on the credit side, it is now going to be called an increase. So the difference between the debit and the credit side is 10,000. So the increase is 10,000 and it will be taken to profit and loss account. Do the same with the next year. Take the balance carried down for the year 2023, 20,000. Take it to 2024 as your balance brought down, 20,000. Before you calculate the increase or decrease, record the balance carried down. In the question, the accounts receivable for 2024 were 150,000. So take the 10% of 150,000, you will get 15,000. So we have recorded the balance carried down and we already have the balance brought down. So what is the difference between 15,000 and 20,000? The difference is 5,000. And the difference is on which side? The difference is on the debit side. So if it is on the debit side, it is a decrease. It means there is a decrease in provision for doubtful debts. So whether it is a decrease or an increase, all of them will be taken to the profit and loss account. So 5,000, record the totals for both sides, and you are done with the account. So that is how we prepare provision for doubtful debts account. So let us now go to the extracts. We begin with the extract of the profit and loss account. So remember, in the provision for doubtful debts account, we are showing there profit and loss. Whether it is an increase or a decrease, we are showing profit and loss. So now when you come to the profit and loss, you're supposed to record whatever you have in the provision for doubtful debts account, but on the opposite side. So for example, in 2022, we have recorded on the credit side of the provision for doubtful debts account. Now when you come to the profit and loss account, you record it on the opposite side, which is the debit side. And then here we are calling it provision for doubtful debts. 10,000, that is the amount for the first year. Then in the next year, there was an increase of 10,000. So we said if it is an increase, you are crediting the provision account and debiting the profit and loss account. So you call it increase in provision for doubtful debts account. When you go to the next year, the third year, remember it was a decrease of 5,000. So we are supposed to credit profit and loss, and we call it decrease in provision for doubtful debts. The amount is 5,000. And then if you go back to the provision account, the 5,000 was recorded on the debit side. And now here we are recording it on the opposite side. So this is the extract of the profit and loss account. you are supposed to show the classification. Extract means you show the part that you are interested in. You're not interested in the whole profit and loss, just the part that you are interested in. So once you write the year, you write here expenses to show that you are classifying this item as an expense. So just show the year and the category where the item falls. So the item falls under expenses, apart from when there is a decrease where it falls under the income. So now we can proceed with the next one, that is the extract of the statement of financial position. So again, once you are asked to prepare an extract, you are supposed to show the correct classification. Remember, we are dealing with accounts receivable, and accounts receivables are classified as current assets. So in our extract, we are supposed to show that the item is a current asset item in all the years. So when you go to the first year, 2022, under the current assets, that is where we are going to show accounts receivable. The amount was 100,000, but we are not going to show 100,000. Instead, we are going to deduct the provision for doubtful debts. So the amount we are going to record is 90,000. And then you go to the next year, you take the accounts receivable for that year, deduct the allowance for doubtful debts, you record the balance. Same thing for the third year, the accounts receivables were 150,000, deduct the provision for doubtful debts 15,000, you record the balance 135,000. That is how we normally record the entries in the statement of financial position. In this case, we have not done the workings for bad debts written off, but assuming you have bad debts written off, you are also supposed to deduct them from the accounts receivable. In fact, if you have both bad debts written off and allowance for doubtful debts, you are supposed to follow this procedure or the order. First, deduct the bad debts written off. Whatever you are remaining with is the one you are going to use to calculate provision for doubtful debts. That is the correct order. First, you deduct the bad debts written off, then the balance you get is the one you are going to multiply with a percentage to get the allowance for doubtful debts. So now that we have prepared the three accounts, next you are going to attempt to prepare the same using this question. So this is a question to the learner. It is similar to the one we have done, but your percentage is going to be 5%. So try and solve it. You can go back to the video if there is something that you need to make a reference on so that you don't get it wrong. That is the end of this lesson. Thank you for watching. See you in the next lesson.